think we will go ahead and get things started. So welcome everybody to Mainsail Financial Group's quarterly overview call. It's a pleasure to be able to spend a few minutes with you tonight. Very grateful for your time as well. Before we dive in, a couple of, let's call it administrative bits to let you know about. Our intention is only to spend maybe 30 minutes or so. We've got two topics we want to cover this evening, and hopefully we'll have a little bit of time for some questions, which I'll get to in a moment. First thing to let you know is that everybody on the call is automatically muted. So if you snort or sneeze, or you want to talk to your kids, or your dog is barking because an Amazon truck is driving by, you don't have to worry. We can't hear it, and nobody else can. The second thing to let you know too is that as we go through this, because everyone is muted, if you do have some questions, at the very bottom, there should be a Q&A button that you can press. Go ahead and type in some questions. We're going to try to answer some of those towards the end of the call, and we'll do our best to keep things on schedule. So my name's Adam Laibson. You see Brandon Steele right next to me, and we are, again, very, very happy to be sharing some information with you tonight that should be helpful and give you a sense of what's happening in this topsy-turvy world. So Brandon, I'm going to turn it over to you to get things started here.
All right. Well, thank you. And thanks everybody for joining us. Really excited to see the participation on our first one of these. If this is helpful, let us know, because we're happy to, we plan to keep rolling these out quarterly. So hopefully this is something that's nice and convenient for everybody. You know, I guess I want to start by thanking everybody for joining us. I feel like this is just such a strange time. A lot of us have had a chance to chat and, you know, kind of get together through happy hour, virtual happy hours, and all that good stuff over the past couple months, but it's been a really tough time. You know, just this last week or so, I've started coming back into the office a little bit more frequently, and I can tell how spoiled, I guess, my dog has been getting, because she has been throwing a fit as I come back home. She's definitely letting me know this is not okay. So, you know, it's interesting. It's a good time. I think, you know, I think it's given us a lot of time with family, and in my case, my dog. But, you know, it's also been extremely challenging. Obviously, this has impacted every single one of us in some way, shape, or form. And the markets, you know, I mean, recently have bounced back to some degree, but certainly aren't helping this. So, you know, maybe to get us started, I wanted to step all the way back and kind of think about where we've come and where we are today. You know, we go all the way back to 2008, I guess, if we want to really put this in perspective. And that basically started the longest bull run in history. That's the longest period of time we have seen a bull run in the markets. You know, even if we look back Q4 of 2018, we may have forgotten that already. But, you know, if you remember, we had a big drop just right around Christmas time that year. And then we had 2019 that just completely wiped that all away like nothing ever happened. I think the markets were up almost 30% for the year. And, you know, coming into 2020, didn't really see any surprises on the horizon. Things looked okay. Started off, you know, pretty strong. And then, of course, we get, you know, this virus that kind of comes out of nowhere and completely wipes everybody, or takes everybody by surprise. So it's been an extremely difficult time. You know, if we look backwards, obviously, this is, you know, kind of the nature of the markets. We never know what or when the shoe drops, but here we are. I think the key is, you know, the way things have gone right now. If you've ever watched a baby try and run for the first time, I feel like that is the scenario we're in, right? Their feet get ahead of them, they end up tumbling. And I think on both sides of the equation, that's what we've seen so far this year. You know, at one point, believe it or not, the stock market was down 35%. That was the kind of the low point in the markets. And since then, it's rebounded significantly. I mean, we haven't, you know, picked up the entire loss yet, but we've picked up quite a bit. And it seemed like this is so important to understand how the market is based on emotions. You know, at that point when the market was down 35%, if you looked at the data and the information that was out at that point, there's no reason Apple, for instance, should have been, you know, 35% cheaper than it was. But it, you know, it was happening across the board because we're fueled by, you know, I guess being a little nervous about what's ahead. Now we switch gears to today, and the market's had this huge run up. And I think it's a little bit the opposite. You know, if we look at the data today, I don't know if that dictates where we should be, but there's a lot of optimism right now, potentially opening things back up. Hopefully the economy gets back rolling. And obviously, as that happens, this will give us a little bit of opportunity moving forward. So I say that just to put this in perspective a little bit. This gives us some opportunities as well, as you might imagine, because it is emotions based. But it's really important to kind of keep that in mind, that the markets are not tied to the economy. I shouldn't say that. The markets are not directly correlated to the economy. They move at different paces. And so it's really important to understand that, to put in perspective what we're seeing today. The tricky part too is I say that standing here today, but tomorrow we have this huge unemployment number coming out. So unemployment rate is going to be released tomorrow. Depending on what comes out of that, and anybody's guess is as good as ours for that number, that could completely change what I'm talking about today. So it's an interesting time where things are literally changing daily, and it's really difficult, as you might imagine, to keep that in perspective with the news that we're all hearing. I don't want to downplay what we're dealing with by any means right now. This has affected everybody's lives. A lot of us may have friends, family members that have gotten sick, potentially even passed away due to this. But I do want to mention that looking backwards, right, every huge market swing, every huge event in our life has been unprecedented at that time. So again, I'm not downplaying this at all. This is extremely serious. It should be taken, really seriously. But I just want to mention that, like, if we look back at 2008, that was an unprecedented times. We all thought we weren't going to make it out of it. 2001, 1987, you get the idea. So, I think that we will make it through this. If the economy does open back up, hopefully that gives us a lot of opportunity moving forward. But there is a lot of noise in the meantime for sure. So to kind of tie this into what we do today. So that's the question, right? So that's all great, but what can we be doing to make it through this? I think there's maybe three things to consider. One is, in the long term, this certainly could be looked at as a potential buying opportunity. But I think the key, as potentially we look at buying, is that it's really important to know what you own and to make sure that you're buying quality assets, quality companies. In other words, companies that have a lot of assets and not a lot of debt. Because those firms who have been carried on by low interest and basically financing their future, those are the ones that may be hurt, pretty significantly through all of this. So it's really important to be cautious, know what you're owning, know what you're buying, if that's something you're taking advantage of. Second is rebalancing. And I think most of you guys have heard us talk about this in the past, but rebalancing is a tried and true, long-term planning strategy that works really well in these scenarios. So think about this situation. Just to make this easy, let's say you're 50% stocks, 50% bonds. That's your portfolio, okay? What we've seen lately is the stock portion of it has shrunk, right? Because we've lost some of the market share in the stocks, and the bond portion as a whole has gotten a little larger. What rebalancing says is in periods like this, you may take chips off the table in the area that has done well and reinvest them into the one that has shrunk. The idea being that, as we notice this rebound, let's say, a few weeks ago, if we didn't do that, we've only got 30% in the stock market. We're not really tied to our, broader allocation. And so we may not experience the full run up moving forward. So rebalancing is extremely important during this period. It may not mean like a full rebalance necessarily, but some level of rebalancing is really important when we have these wild swings, what was daily not too long ago. And then the third thing to wrap up is really keeping in mind a long-term focus. Right now, the news, everywhere that we turn is some sort of news, and most of it is bad. And so it's really easy to get wrapped up in what we're experiencing today. But we need to take a step back and remember where we're going. Whether it's retirement, whatever the goal may be, the key is to focus on what we're really aiming for and know that, assuming we get through this, things will be okay. We'll be able to come out on the other side, hopefully stronger than we went into it. But not to throw away the baby with the bathwater, if that makes sense. This is a really tricky time, and emotions can get really heavy. And so it's really important just to kind of keep that in mind, put some perspective around this, and make sure that we're doing all we can in these periods, but keeping a long-term focus throughout. So I think, hopefully that's helpful. That's maybe I guess what I wanted to share on the market side of things. And then I'll kind of kick it over to Adam. There's a lot of legislation changes that have gone on this year as well. So he's going to talk a little bit about that.
Thank you very much. Great job, Brandon. So it's been interesting. For quite a while, there had not been a lot of changes in tax law or in legislation around retirement that has a direct impact on a lot of people. And interestingly, in the last 5 months, we've had 2 legislative pieces that have passed and been implemented that have a direct impact on how we do some of our financial planning. And so what I wanted to do was cover some of those, hit some of the more commonly known or commonly questioned pieces of the 2 acts we're going to talk about, and share with you some ideas and things to consider and how they can be beneficial. The first one is the Secure Act. And so it feels like a lifetime ago, but this one actually passed on January 1st of this year. And so the Secure Act has been a long time coming. And what it does and what it did was to provide some greatly needed updates to some of our retirement planning rules. So before I get into some of that, I just want to share like a little Secure Act fun fact. So Congress, as it always does, likes to create acronyms for everything. And I would bet that most of you probably don't know what Secure actually stands for in Secure Act. So I'm going to give this to you now. If you want to write it down, that's fine, because one day you may find yourself on Jeopardy and win a lot of money with this question. So Secure actually stands for Setting Every Community Up for Retirement Enhancement. Yep, that's right.
Now the trick is remembering that.
That's right. Well, luckily it goes by an acronym, which is Secure, so it's easy for everyone to remember. So there was a lot in that, but there's really a couple of points I want to hit. The first one is that the required minimum distributions, RMDs, the age requirement has been changed. And so I believe most everybody knows what an RMD is, but I'll just describe that really quick. When we are contributing money to tax qualified plans, whether it's a 401k or a traditional IRA, for example, any plan where we don't pay tax on the contributions or the earnings, these accounts are subject to a required minimum distribution. In other words, the IRS has said, okay, you've had this money in the account long enough, you've never paid a penny in taxes, and now it's time, we want what's coming to us. And so they publish a table that says and shows every year, starting at age 70 and a half, what percentage of that of your retirement balances, those qualified plans, has to be distributed to you, and you pay tax on that amount, like ordinary income. So up until the Secure Act had passed, that age was 70 and a half. Now with Secure Act, they've changed it. They've actually raised that age to 72, which in a way is actually pretty good because it gives people a little longer for those retirement dollars to grow, dividends to be reinvested, account values to recover and move to a much higher level. So it's actually a benefit and can prove to be helpful with overall planning. Now, a couple things to consider. One is that if someone has already started taking RMDs, then they have to continue taking RMDs. They can't stop. So that's a challenge. But the other part of it is that for those that haven't retired yet or are close to retirement, or maybe were 70 and a quarter when this passed, you can wait. You can give it another 18 months or before you have to start taking those distributions and paying tax. So that's one piece of it. Another piece that was very interesting and important from a planning perspective is that the age limit to contribute to a traditional IRA was basically removed. So if you're working, let's say that you're 72 or even 75 and working for an employer that has a 401k, as long as you're employed, you can still keep making contributions, okay? Now, when it comes to an individual retirement account outside of the workplace, if you're working, you can make contributions, but as long as you were 70 or younger. So now that age requirement is removed, so if you are 75 years old and still working, you can also make contributions to a traditional IRA outside of the employer plan. So that's a minor detail, a minor piece of planning, but for some people it's very important because it gives them an opportunity to continue to save. Now, the other one, the third piece I want to talk about, the last piece, which is pretty important, is that there is a change to the way beneficiary IRAs are distributed. So in the old version, before Secure passed, if somebody passed away that had a qualified plan like an IRA or a 401k, the beneficiary that inherited the account would essentially have to take their own required minimum distribution, but it would be based on their age. So if an account got passed to a kid that was in their 40s or 50s, they wouldn't have to take out very much and therefore wouldn't have to pay very much in tax. And that could continue for the entire lifetime of that beneficiary, okay? So what's changed is that the beneficiary time frame for distribution is no longer based on age. It is a flat 10 years. Now, there's a couple of exceptions, which I'll get to in just a moment. But basically what that would mean is that if there's a parent that has a $500,000 IRA account and they pass away with a 40-year-old child, that 40-year-old child now has 10 years to essentially drain the account, right? To take a full distribution. Now, what the rule does not say is how that has to be done. So in other words, they could take 1/10 every year for 10 years. They could take out quite a bit early on and the rest at the very end. They could take out the entire amount plus all the gains plus everything else the day before that 10-year mark, right? That part is very fluid and flexible, but the part to consider is the tax, because whenever you take those distributions, it's going to be taxed like ordinary income. And the challenge is that in most cases where a grown child is inheriting a beneficiary IRA, they're probably going to be in their higher income earning years and therefore may have to end up paying even more in taxes, right? So the IRS, they know what they're doing when they pass these changes. So even though you can wait longer before you have to start an RMD, the beneficiaries may have to end up paying more in tax. Now, the exceptions to this are for a surviving spouse, a minor child, so a kid that's under 18, a beneficiary under 18, or any beneficiary that's less than 10 years younger than the person who passes away. Okay, so kind of keep that in mind. But for the most part, it does represent a big change in how those beneficiary accounts are distributed. Now, the last thing I'll say about this is that this only goes into effect for anyone that's passed away from January 1st of this year going forward. So if someone is already taking our beneficiary RMDs in that stretch capacity based on their own age, that's not going to change. It's only for anything that's new from January 1st going forward. So hopefully that makes sense. The next thing I want to talk about briefly is the second piece of legislation that happened just, 4 or 5 weeks ago, and that's the CARES Act, all right? And just like I asked about the SECURE Act, I'm going to give you the fun fact of what CARES stands for. It's Coronavirus Aid, Relief, and Economic Security, which sometimes people roll their eyes at when they hear economic security, but it is what it is. So this is the package that contained the PPP loans for small businesses to maintain their payrolls. It had provisions for healthcare reimbursements. There was a whole lot of stuff in there. Increased benefits for unemployment. And I'm not here to talk about all of that because that's complicated and as we're finding every day, still a little unclear and uncertain for a lot of folks. But there are a couple of planning and tax pieces I do want to mention that came from that. The first one is that one of the, I think, very kind things that Congress did is they actually removed the required minimum distribution for 2020. So if you were taking RMDs, however old you might be, you are now given the option to essentially opt out for the rest of the year. Now, the reason why is because the market was humming along and doing great at the end of 2019. Required minimum distribution values are based on age of the individual and the account value at the end of the prior year. That's how the calculation is made. So here's what's happened. At the end of 2019, account values were running very, very high. The market was doing well. So here we hit 2020 and the market, as Brandon mentioned before, lost 30% of its value. So it doesn't seem very fair to have to take out a much higher RMD based on a good market that we saw at the end of the year from account values that have dropped by 30%. So that is why Congress said, okay, you know what? Everyone's okay. You don't have to take an RMD for 2020. Now, with that said, the CARES Act came out in March, passed in March. So any RMDs that have already been taken for January and February, you can't put them back. I mean, it's done, it's over. But going forward for the rest of the year, you can opt out and choose not to take RMDs and let those dollars stay in those invested accounts to increase the chance of them growing and recovering to values that we saw earlier. So that's a piece that we're seeing from our own experience with our families and our clients that a lot of people are taking advantage of. But again, it's an option. There's no requirement to do that. The second piece that I'm going to mention, and I'm going to talk about it, even though the actual statute is still a little vague, but some people have been asking about this, and I think it's important to mention. So there is also a provision in the CARES Act that allows people to take out up to $100,000 from a qualified plan without paying a penalty. Okay. Now I'm going to back up a little bit and kind of talk that one through a little bit, because there's a couple of conditions that go with that, and I'll explain to you where it's still a little vague. So one of the conditions is that you have to be affected by coronavirus. Either you were diagnosed with it, you were sick with it. I think the way it reads is if you were adversely affected by coronavirus, which I believe probably everybody could argue in some way, shape, or form they were. So that part of it is, is a little unclear, although I think it might apply to everyone. But the part that's worth considering is what happens after you borrow that money. So the way it stands right now is if you took money out of a traditional IRA or a 401k before 59.5, before the penalty goes away, you would normally pay tax on that distribution as well as a 10% penalty. Like that is the rule as it stands right now. So what this particular provision is allowing is for people to take out up to 100,000, as I mentioned, but it waives the 10% penalty. So no need to pay the 10%. That certainly can be very helpful because that penalty is just paid off to the IRS and money you'll never get any benefit from. So where it gets a little vague is how that money is basically repaid. So the way it stands now is that if you borrow up to 100,000, you have 3 years essentially to repay that back into the account that it came from. Now, normally when you take a distribution, you would pay tax like ordinary income for the full distribution in the year that you take it, if that makes sense. So if I took out 100,000 from my traditional IRA, I'm going to pay tax in 2020 like ordinary income. So the way this is different is that if I take this out due to hardship, essentially, I have a couple of options. I can pay this back into my account over 3 years. And if I do that, then I'm made whole. There's no penalties, there's no taxes, there's no issues. If I don't do that, if I decide I'm going to keep it and not paying it back, then I still would owe the tax on those dollars like ordinary income. But now we're talking about a 3-year period. So if you were to pay it back, essentially, you would get a tax credit each year that you put that money back for the amount you are putting back. That makes sense. If I have a $100,000 loan, let's make it different. If I have a $60,000 loan and I pay back $20,000 each year, I'm going to get a tax credit for a third of the tax I paid for that full distribution. Okay. Now, again, the way this is written out is still a little bit vague, but the idea, the before and the after, is that if you pay it back within 3 years, there's no penalties and there's no taxes that are due. It's just allowing for folks that want to take money from a qualified plan, if that's their only option for survival, essentially, to do that without having any adverse effects. Okay, so I think what will probably happen a little bit later in the year, like we've seen with other new tax law changes that are sort of put out there, is we'll get more guidance on the IRS on exactly how that's handled. But I did want to mention that provision because there are some folks out there that are facing some significant financial hardships and looking for ways that they can use some of their savings to shore things up until times get a little bit better. So I think that is the intention. I think, as all of you know, the CARES Act was kind of cobbled together pretty quick, and Congress's and the government's heart was in the right place, but in the rush to get a lot of this out to help people, a lot of the details just haven't quite been finalized yet. So we'll get more guidance on that later this year. So hopefully that makes sense. So those are the two pieces that I wanted to cover on the CARES Act to give you a sense of how we may be able to use that from a planning perspective. But I think that's really all that I wanted to cover on those two acts. There's a few more pieces in there, but those are the most relevant ones. And so that's really all I wanted to share with you this evening too. I wanted to see if anybody had any questions about any of these things that Brandon talked about or I did. I saw a question about how are RMDs calculated. So I think I touched on that before, but basically the way that's addressed is that if the ending balance of a traditional IRA was $100,000 at the end of 2019, if that was your closing balance December 31st, then that value is what's used along with the RMD table to determine exactly how much has to come out. That's how that calculation is made. And if any of you have seen the RMD table before, what it basically says and shows is that it's like a mortality table. So the older you are, the IRS thinks that you have fewer and fewer years ahead of you, and therefore the percentage changes that has to come out. So the RMD is not the same for everybody every single year. It's always recalculated. So if the market were to close, like if we go back a year, when 2018 closed out. 2018, almost literally the worst day of the year in the market was December 31st. It might have been December 30th. So the benefit is that for those that have to take RMDs, they're forced to take out a lower amount, right? So that's how RMDs are calculated, and that's, I guess, an explanation of what that term means as we go through that. You see any, Brandon, for you?
Yeah, I saw another question earlier about interest rates. Basically just, what are our thoughts on interest rates and where they may go? I think most people may be aware that interest rates are, the Fed rate is actually basically zero. So interest rates are extremely low, and they've been hovering around these low points for a while, especially given what's gone on lately. So the challenge is that I shouldn't say there is nowhere to go but up, because there are some other countries that have gone negative rates, believe it or not. So that may be an option. In fact, that's something that we're hearing a little bit more and more about recently. Hopefully that doesn't happen, because there's some implications to that. But I guess as we look forward, I think the challenge is that, and I know a lot of us have talked about this, but with bonds, which is supposed to be the conservative portion of our portfolio, right? It's supposed to be the safe piece. But the challenge is that interest rates rise, bond prices fall. And so right now, when we look at interest rates from this perspective, from an investment perspective, I think it's really important to be cautious in the bond market. And the way you do that is, instead of buying long-term bonds, you can buy short-term bonds. Think like a teeter-totter. The shorter that plank, the smaller the swings. And so that's something that we're looking at. It's not necessarily that we feel like interest rates will rise tomorrow, but we're not getting a whole lot to extend that plank. Not much more interest, and the risk is much higher. So it's a little safer view on things. I think interest rates will stay low for a while, but at some point they've got to go up. And, maybe when we're through all this, we may start to see a little bit of that start.
So I see another one, if you don't mind answering a second one, Brandon. So the question, this is going to be a hard one to answer quickly, but we'll try. So what does it mean when oil goes negative? How does that work?
Yeah, good question. And if anybody was following that, it didn't last long, but oil did go negative. And actually what that meant was that there was nowhere to store all these just the surplus supply of oil. And so people were actually willing to pay you to hold it, is basically what that means. Now we're through that oil has picked up significantly since, but it was something that happened for a day, and it was obviously big conversation for sure. As people get back to work, potentially slowly the economy opens up, and I think maybe more people are driving, that certainly will change. But China is one of the biggest consumers of energy, and so that has been a huge hit to oil prices and oil demand.
Good. All right, we have time for one last one, which I'll take because it's a short answer and an easy one. Is the $100,000 loan amount per account or per individual? And the answer is it's per individual. So the way the rule stands is that it doesn't necessarily matter whether it comes from one account or multiple accounts. It's more about the dollar maximum per person. Okay, and that could be, by the way, if there are two spouses, it can be $100,000 per person. So that there's opportunity for even more there. Okay, but it is based on the individual and not the account. Very good. Okay, so I think that brings us to about a half an hour, 30 minutes. We want to be good to our word. Thank you all very, very much for tuning in. We try to keep these, I don't want to say short and sweet, but we want to make sure that we're covering things from a high level and give you a sense of what we're paying attention to and what we're looking at. If there are some specific questions, please feel free to email us directly or reach out. But with that said, we want to wish all of you a wonderful evening. Enjoy the sunshine, and stay tuned for details on the next quarterly overview call that we have in a couple months. All right. Thanks, everybody. Have a great evening.
Thanks, guys. Stay safe.